Welcome everyone to our Opus Faveo webinar from Survive to Thrive, Early Stage Venture Development. We're delighted to have everybody here. My name is John Dupree. I'm a partner at Opus Faveo, and joining me is my partner, Christian Blackwell.
Hello everyone, glad to be here and glad you all could join us.
If you've been to previous Opus Faveo webinars before, you may recognize a little bit of a new format. That's because we're testing out a new webinar provider, so we hope you'll let us know whether this is better or worse, but we're glad you're here today for this. I think it'll be a very interesting 30 minutes. To get things started, we'll start things somewhat metaphorically and talk a little bit about something in Texas that is very popular this time of year, and that's the hatching of the sea turtles on the Texas coast. Lots of tourists come and watch these animals hatch and then make their way to the sea where they start their new lives as sea turtles. It's a very popular tourist spot, but one thing that the Texas Tourist Board doesn't really tell you is less than 1 in 1,000 of these little guys survive, even after they're hatched. A lot of things can be a problem for them. Obstacles, driftwood, even a person's footprint can be too big of a barrier for them to get through to the water. Predators, obviously, garbage inputs. They sometimes eat tar or garbage thinking it's food, and even disorientation. Instead of moving to the lighted horizon represented by the sea, sometimes they get confused by car headlights or something else. But their survivability rate is really terrible. Now, because this is a metaphor, you can probably see where we're going with this. It's very similar with business hatchlings or startups or spin-outs. This is a fairly famous graph that CB Insights did, studying over 1,000 startups that got funded, their seed funding in 2009, 2010, followed them through the end of 2015, and found a disturbing fact that even after funding, 4 out of 5 of these failed. And of the 1 out of 5 that survived, they didn't return, most didn't return a sizable return to their investors. They were basically existing, but they weren't generating lots of money. So although it's a better rate than sea turtles, this is really not a great survivability rate. It's a super high failure rate. And as you think about it, they're probably succumbing to the same thing that turtles do. Obstacles, predators like competitors, garbage inputs and advice from people and institutions, and just a general market disorientation. So we should have, given all of the efforts put into this, a better survivability rates of our new companies.
So John, should we be going down to the Texas Gulf Coast and helping turtles on the beach?
No, but we should be doing something, and historically we have tried a few things, Christian.
Well, you know, in today's startup market, really the preeminent vehicle is the accelerator. And the basic model of the accelerator, we all probably know, is that they take a small piece of equity. They provide this acceleration program generally around 12 weeks. It's cohort-based with a class of entrepreneurs who are going through it. And as part of this program, they are being taught how to pitch and how to refine the value proposition, et cetera, through mentorship and education. In some ways, it looks a little bit like an executive MBA with this heavy mentorship program and, of course, a very short timeline. You also have incubators. The basic idea of the incubator, which in many respects predates the concept of the accelerator, is that the incubator is providing more business assistant services. So first and foremost among those is office space. And then a lot of the stuff that the accelerator provides. Today you actually see a lot of accelerators tied to incubators. But the basic idea is that they're providing a little heavier support for the startup. In reality, though, the dividing lines between accelerators, incubators, and even seed funds are pretty blurry. These things tend to overlap each other quite a bit, and they're evolving, they're changing. You've got accelerators that are being vehicles for seed capital, like Y Combinator, one of the first accelerators. Y Combinator and Techstars are generally viewed as being the first to create that accelerator model. You have accelerators that are blending with incubators, as I already mentioned. You've got incubators that are tying to real estate projects. One of the first that I remember seeing was the Cambridge Innovation Center in Massachusetts, but you're seeing this in Toronto at Mars, in New York as part of Startup New York, and various other places where the incubator is actually becoming this kind of real estate project. And we've actually been made aware of real estate investment funds, REITs actually, that are getting into this space. So you've got hybrids, you've got lots of different variations on this theme, all trying to accelerate the creation of startups, or to foster the creation of startups.
So how are we doing?
Well, why is there so much confusion in evolution? It's not because the model is working and it's working well, or a model is working and working well. Lots of skepticism, and you're starting to see this all over the press on the subject, media on this subject, and among policymakers in municipal, regional, state, and even national governments that have been supporting accelerators. You're starting to see people ask these questions of, well, how should we measure success for these things? Traditionally, it's on how much capital is raised. And what should we expect coming out of these? Now, we think these are good questions to be asking because we want better performance. We want to see more of these things. One of the key takeaways, and go back in your mind to that funnel chart that John presented a little bit earlier, and in that funnel, 793 of that 1,000 whatever number that we started off with, 793 dead and dying, and this is after that initial funding. So just because you've gotten that funding coming out of the accelerator doesn't mean that you've actually been successful in building a company.
And Christian, that's a key point, because many traditional accelerators exist precisely to get you that seed funding, and yet even after having done that, the survivability rate is abysmal.
Yeah. And it's sad for those of us who want to see more of this stuff happening. It really is sad that it's not working better than it is. So what about VC? One of the great ironies is that in the post-Great Recession environment around the world, and particularly now after Brexit, there is all of this suspicion of capital markets players, of large banks, etc. And one of the few places where you see a high degree of confidence in the capital markets is in VC. There is this general sense that VC investors somehow are the good guys, and they're going to help make this happen. And when I say that general sense, I mean in the general public, still among policymakers, we see a lot of this. And yet, when you start talking to entrepreneurs, that's where you see a slightly different story. In entrepreneurs, in discussions with entrepreneurs, you start to see people say, well, the VCs say they're going to mentor, they say they're going to provide these resources, but they don't always do that. Clearly, the good ones are doing all these things, but there are a lot of VCs out there, and many of them say that they're doing it, and they're not. There's a sense that the interests of the VCs are different than those of the entrepreneurs. And this makes sense, it's logical, but entrepreneurs are seeing that play out. And they're seeing it in the form of VCs that are, and I'll put this word in quotes, stealing the company from the entrepreneur or from the founder. One of the other aspects, and this is another place that you're starting to see some pushback, is from the LPs, from the investors in VC funds. They're starting to ask questions about success rates, about performance, about correlation to broader market indices, all of these things that the LPs want. And so VCs are actually having to focus more and more of their efforts on raising the next round of funding. And finally, and perhaps most importantly, when you look at what's going on in the VC market, is that VC firms are finding this huge pressure, that particularly the successful ones, to grow. And when they grow, they have to deploy more capital. And if you deploy more capital, you have less time to deal with early stage companies with smaller companies, and you have a huge incentive to deploy capital. So there is this desire for capital efficiency among investors. They want to see companies that are efficient in deploying capital, but ironically, they also, from their fund mechanic standpoint, have to deploy large amounts of capital. It's strange but true.
And, you know, Christian, we see this at a real daily level with even our Opus Faveo portfolio companies. We'll often ask one of our institutional investors in a portfolio company this question. Now, how much time do you allocate to work directly with our portfolio company's management team over the next 18 months? And most VCs, most institutional investors, will know exactly how much capital they have budgeted to deploy over the next couple of rounds of funding when they take on an early stage company, and sometimes down to the penny. But if you ask them how much time are you going to spend nurturing and developing the team and the business, it's sort of a deer in the headlights look because they haven't really thought about it. And occasionally you'll get the answer of, hey, we'll take as much as it takes to do that, which is really a silly answer given that human capital is in many cases as valuable as financial capital. Why would you have such a cavalier attitude about the human capital necessary to make a startup or an early stage company work? And it just goes to show you that their competency and their expertise is really in deploying financial capital, not deploying human capital, and they're not filling that void of acceleration that we're continuing to see being a problem of startup survivability. So for early stage fundings, a lot of people are going to angels, and the angel networks and angel investors are taking up a lot of the slack because of the inability of the large VCs to deploy small amounts of capital, as Christian told you. But that creates some of its own problems. You know, VCs are hoping that accelerators are bringing them investor-ready deals, but you know, the funnel we showed you suggests that that may not be the case, that they're getting a lot of deals that appear to be investor-ready but aren't really. And the other problem that angels have is sort of the reverse of the problem that VCs have, where they're investing, they need to invest big lots of money. Angels can invest small amounts of money, but they have to do it in a large number of companies in order to succeed because of the survivability rate. They have to have a portfolio in hopes that they have captured some of those small percentages of companies that actually succeed. And when they have that large portfolio, they also don't have the time to nurture the companies in order to make them succeed. So accelerators may help attract companies, but they don't help them nurture those companies.
Yeah, and one of the unfortunate things with angels is that, and we see this a lot, you have angels, high net worth individuals who want to invest in startups. They invest in a couple. They don't turn out the way they'd like. Often they don't have the resources that a VC has in terms of networks, vetted vendors, etc., to make companies successful. The angel has a bad experience and they're out. And if you want to see more of this stuff happen, if you want to see more startup activity, you need to have successful angels, because those angels will continue investing, they'll invest larger amounts, and they'll get better at it.
So now to the meat of the discussion today. We believe that all of these types of accelerating vehicles fail because of a fundamental misunderstanding of the assumptions around which they're made. And we believe that the problem begins precisely with foundational assumptions of accelerators, and they're really what we've described here on the left. Accelerators assume that there's an incented and energized bunch of founders out there, and it's really a matter of weeding out the best ones. They assume that these founders understand what it will take mentally, emotionally, and professionally to start, to grow, and to nurture a company, and that if there are identified gaps in the management team or the founder's capability, it can be quickly filled with money, a little bit of education, and access to a network. And that after launching the company, it should be able to survive with simple mentorship. That's really foundational to how all the accelerators work with their founder CEOs. Our experience with our own portfolio companies suggests that this just isn't always the case. In fact, we would say it isn't often the case. we see a different set of assumptions. One is that there are fabulous opportunities for which there aren't ready-made founders with time, energy, skill, and desire. We don't believe that 4 out of 5 of those companies in that funnel failed because the ideas were bad. We think there are lots of terrific ideas that are failing simply because the management of the enterprise has gaps that aren't being filled.
And we've actually done research on this, talking to university tech transfer offices, talking to investors, surveying these people, and one of the main reasons that people cite for failure, John, is lack of management expertise, right?
Well, when you think about it, you have to have time, energy, skill, and desire. And you can have all 4, but you can't have 2 of the 4, you can't have 3 of the 4. You can't have time, energy, and desire, but no skill. You can't have energy, skill, and desire, but no time. You're really asking that founder, CEO to be almost a Superman. And that's terrific, but those people are going to be the exception rather than the rule, and I think that's borne out by the survivability rate. Even competent founders that have time, energy, skill, and desire can be overwhelmed because the deck is stacked against them. Starting a company is just hard. Additionally, so much of the help that founding CEOs and founding management teams gets is getting funded help. And what we have found is that getting funded in many ways is the easiest part. That's the beginning of the adventure. The hard part is getting profitable customers. And so, as you see in that funnel, a lot of companies simply die. They fizzle out through loss of momentum, and that means they fizzle out through a loss of cash. So we think that based on our experience, there is a new model. There's a way to build a better survivability rate that doesn't depend on wishful thinking.
So that model is venture development. So what exactly is venture development? Well, venture development is like a protective shell around that startup hatchling. The idea of venture development, rather than accelerating for 12 weeks or giving some office space for 12 months, the venture development firm is really trying to build the company. And it is investing in its own expertise and developing that expertise to get better at building companies. It's looking for resources that it can attract to that new venture, that startup. Those resources are customers, first and foremost, because that's really what's going to create the long-term viability of a company. It's team members. And if you look at companies past that accelerator stage, once they have some money, one of the biggest challenges they cite is the ability to attract team members. VCs talk a lot about this as well. Capital certainly is part of the equation, but it's not just that first round of capital, but it's capital throughout the maturation process of the company. And that capital can take lots of different forms. And other resources, the kinds of things that a good VC provides, but again, the venture development firm is solely focused on this maturation process and improving it. So it is constantly on the lookout for resources, be they IP attorneys or accountants or web developers or what have you.
So Christian, how does that happen? What makes it work?
Yeah. So this venture development firm, again, who's the firm's expertise is in building companies. That venture development firm gets embedded into the company as a co-founder. So you'll have other founders, entrepreneurs around the table. That venture development is itself a co-founder. The venture development individuals are active participants. That firm is an active participant in the startup. So it's not giving advice. Granted, there is advice from time to time in coaching, but really it's not saying, hey, you should develop a slide that shows X, Y, and Z in that deck for a customer. Rather, the venture development firm is developing that slide. It's part of the team. And then finally, when it comes to compensation, the venture development firm's compensation is primarily through equity, in line with the other founders. So how does that venture development firm make money? It makes money by building successful companies. Its compensation is at risk. So a good analogy here is that accelerators get the startup into that room to talk to investors, etc. Venture capital puts the startup at the table. Maybe that's the table with customers. It creates a little more momentum. But the venture development firm is within that startup. It's part of the team for the entire life cycle, from launch, from the earliest stages, all the way through to an exit. And I'll add that in the case of the venture development firm, an exit is not necessarily a foregiven requirement. The exit doesn't necessarily have to happen, because if the founders can make money by just generating a lot of cash flow, maybe the venture development firm is happy with that as well.
So, Christian, let's talk about just the 7 ways venture development may differentiate itself from accelerators and incubators and seed funds.
Yeah. So, first off, we talk about depth. It's, again, not just this periodic, episodic mentorship, but real hands-on work. And coaching of the team certainly exists, but it is thorough, ongoing, daily, weekly. But again, the big differentiator is hands-on work. Secondly, breadth. It's not just for 12 weeks or 12 months. This is long-term, beginning to end. It's not just acceleration, it's stamina.
The third one I would suggest would be commitment. These are co-founders. These aren't advisors. These aren't mentors. And we use the term, and I like it a lot, embedded. These are embedded insiders. These are not outsiders giving advice. Now, I'm going to come back to that insider-outsider reference in a minute, but think of these as embedded insiders sitting in the company side by side, with equity aligned exactly with the other founders, and with compensation that only generates itself if the company is successful. And the other is, obviously, there's a focus. This is unique to every single company. This is not a cohort base. These are not classes. I'll just say, in our Opus Faveo portfolio right now, we have a robotics company, an apparel company, advanced materials company. In a class together, I'm not sure that there's too terribly much that is horizontal. We have to build programs specifically for their marketplace, for their customer base, for their strategic partners.
Next is capital agnosticism. We alluded to this earlier, but we think this is a real powerful part of venture development, and that is that the VenDev firm is not incented to place capital, and it's not incented to place a certain kind of capital. So whether it's debt, whether it's equity from high net worth, whether it's strategic, or some new novel thing that you come up with as a way to fund a company, it doesn't really matter. The VenDev firm is completely capital agnostic. Cash efficiency, even though large VC firms are trying to place a lot of capital, there's still a lot of talk about cash efficiency in the industry, because it's viewed as an indicator, and maybe a leading indicator, for startup success. In the case of VenDev, because this compensation is weighted to equity, it really, really helps in terms of that cash efficiency, because you're getting a much, much deeper bench for very little money.
And the other thing, and it's a big thing, the last thing we'll say, is operational experience. On the right, you see the sort of vicious cycle for entrepreneurs, that they need funding, but the investors want to see a proven management team, but the proven management team obviously wants funding, and it becomes a terrible cycle. VenDev provides a lot of that experience and outsider perspective, and that operational experience. In many cases, people that are slightly more seasoned. So VenDev firms have to have a ready network of operational resources ready to deploy in a way that both the VenDev firm and the startup are comfortable with. At some point, the startup will transition to full-time management, but this becomes a very efficient way of doing so. So, we're really talking about embedded insiders, but who have an outsider perspective. So we say that the condition of these VenDev helpers are outsiders, but their position is insiders embedded in that company.
So we talked about this really from 2 perspectives so far. We talked about this from the perspective of the kind of policymaker who's looking at this from a top-down level, saying, I want to see more innovation and more startups. And we talked about it from the standpoint of the entrepreneur or the founder with an idea, who's maybe thinking about an accelerator and so on. But perhaps most importantly, VenDev is actually something that can really, really help investors. And that is because of specialization. All funders are trying to raise capital. This is institutional VCs. They're trying to raise capital, and they're trying to pick the right companies. And if you think of expertise, those are two key skills. They're hard to do, and a good VC is going to be able to do those right. And this is true with university tech transfer offices as well. But here's the thing. If you believe in specialization, well, all of this other stuff that we've talked about from a VenDev standpoint, the things that a good venture development firm ought to be doing, well, those are yet other skills that a venture capital firm needs to invest in somehow. But if their LPs are wanting them to be more efficient and spend less money, if they themselves want to concentrate in building up their key skills, there's a huge incentive for them to want VenDev as a way to outsource some of these other skills, and to do it in a way that, again, is very, very cost efficient to them.
It really doesn't cost, you could say, it doesn't really cost the venture capital or the TPO anything to do this, right?
That's right. It's costing the other co-founders, but those other co-founders are primarily concerned with creating a company, and they know that the biggest risk is that they're just going to fizzle. So if you got lots of resources for no money, that makes a lot of sense.
Yeah,
for everyone around the table.
So who do VenDev? Right now, Opus Faveo, we do this, and we're hoping to build a history of success that proves out this model. But there really should be hundreds of Opus Faveos around, and every university should be considering, VenDev. There are some requirements for VenDev to be done appropriately, and we've listed some here. The baseline is that you have to have financial patience. There has to be entrepreneurial incentive. You have to have access to experience management, an operational network, and commitment to this as a vocation, not an avocation. This is not something for retirees to do 3 hours a month. This is a job like venture capital is a job. We do believe that VenDev firms are in a great place to exploit experience management. There are tremendous amounts of seasoned potential startup managers out there that exist. They're just not very efficiently deployed, and they want to be a part of starting new things. But like venture capital itself, it's a bit of a kludgy deployment to get them into the right hands at the right time. So who might be doing this? Well, universities should be doing this. It would be natural for a university, particularly with the access of a huge alumni network, to build an internal VenDev group. There is a ton of alumni money being currently invested in big buildings, in incubators, and all sorts of the wrong things, and that money could be redeployed to build a VenDev team within a university to have powerful results. Angel investors might make VenDev an important part of their engagements by simply saying, we will invest in this company if you are associated with a VenDev firm. It doesn't cost the angel investor anything to do that. And it, at some point, is going to create a much higher success rate for that angel investor. So we think that this is an easy thing to do. VCs might ultimately want to outsource a lot of the nurturing of early stage startups to VenDev firms in order to keep early stage companies in their portfolio. Right now they can't, because the need to deploy high amounts of capital and nourish those companies makes it inefficient for them. But if they were able to outsource that development, they would be able to maintain a small portion of early stage startup companies within their portfolio, and VenDev allows them to do that. So really, today we just want to introduce you to a new model, the model of venture development, which is different from venture capital, different from accelerators, different from incubators, different from seed capital. It is a new thing that we're doing here at Opus Faveo, and we'd like to see other people copy us around the country, because thriving is more than just hatching. It's not enough to found a company. It's not enough to fund a company. You have to reduce the obstacles to growth. You have to identify and respond to competitors and sort of corporate predators. You have to eliminate all of the garbage inputs you receive from well-meaning and not so well-meaning people, and you have to orient to the light. You have to find the market, you have to find the customers, and you have to go there quickly and efficiently. And that's really what VenDev helps these entrepreneurial CEOs and their management teams do, and that's why we think this is a really powerful model that we'd love to talk to you more about.
So I guess we're going to be hanging out on that beach on the Texas Gulf Coast, helping.
Well, hopefully we'll be
helping the
making
turtles.
it, we'll be having our little turtles make it to the big sea.
Well, very good. That concludes the meat of the webinar. Just very quickly, please reach out to us if you have any questions about venture development, about what we do as a firm, or about a specific startup opportunity. We love to talk to people, and we'd be happy to speak to you. So you can reach us at info@opusfaveo.com. And if you are an institution, an angel fund, something of the sort, angel network, we do a valuation forum where we talk about valuation techniques that a lot of people have told us has been very helpful to them. So we enjoy doing that, and also encourage you to ask about that.